Hi, this is Andrew Zezas, President and CEO of New Jersey-based Real Estate Strategies Corporation, coming to you today as part of our CFO video interview series. Today we have the pleasure of interviewing Tim Anglim. Tim is President of YesCFO and CPA Forensics. Tim, thanks for being with us.
Andy, thank you.
It's a pleasure to have you.
My pleasure.
Tim, we got some really wild and interesting stuff going on in the economy today, so I wanted to jump right in with some questions about your views as to where things are going. My first question has to do with companies and banking. Has the economic situation in which we currently find ourselves and what we've been experiencing adversely impacted companies' ability to secure bank financing?
Yes, and it will continue into the foreseeable future. Take TARP, for instance, the government's program to help support lending in the banking community just a few years ago. Banks got into that program as a way to create a backup or reserve to their ability to raise funds. And as they approached what they thought was an abyss in the credit crisis, in the credit markets, they saw this as a way to shore up bank balance sheets. Unfortunately, subsequent to banks going into these agreements, the regulators came out and put in some very, very tight controls and got into the management of the banks themselves. So almost every bank has tried to or is in the process of paying back those funds. Unfortunately, paying back those funds now is just when you need to keep that cash on the balance sheet of a bank. It has to come out of somewhere, and it's going to reduce reserves and reduce the ability of banks to continue lending. And so it's going to create a little more of a slowdown effect for a while.
Interesting. Banks minimizing reserves doesn't sound like a very good thing.
Increasing reserves and minimizing the cash balances out there.
Minimizing.
Yes. Yeah, cash reserves.
Let's talk about companies and capital spending. Is it fair to assume, well, not fair to assume, but will companies be increasing or decreasing capital spending in 2010 over 2009?
Probably increasing. There are three types of capital spending that most financial folks lump that category of spending into. There's the basic maintenance or if you will, replacement cost capital spending. There's capital spending for growth opportunities, and there's capital spending for reduction of cost or efficiency improvements. The last two categories are discretionary to a certain degree, so they tend to suffer. As the economy does pick up at some point, that discretionary part would start to pick up as well. So yeah, I would expect that in 2010 you would see somewhat of an increase over 2009.
Somewhat of an increase.
But it depends. It depends.
And you're
on
expecting
industry.
marginal increases?
I think it depends on industry. I mean, you could take a government contractor who may have not seen any fall off in business because they're funding either the war effort or they're involved in research and development that is critical to the government or the space industry, as opposed to a consumer products company which has completely fallen off a cliff last year.
Right. Interesting dynamic. We talked a little bit about financing by companies. Let's talk about bank financing agreements. Have agreements themselves been affected by the current economic circumstance in which we find ourselves?
Yes. It's tougher to get to a yes in an agreement, to get a commitment from a bank to begin with. Additionally, when you do get such an agreement, it comes at greater cost. It'll be laden with more fees. The banks are pressured by artificially low interest rates. Consequently, they're trying to improve their profit margins through other means and agreements. Additionally, you have controls from the regulatory side of the picture that have created a lot of second guessing. Traditionally, in any company, whether it's banking or anything else, you always have the credit issue, the credit worthiness of a customer. Well, the banks are no different. They have credit departments. They look at the business sense of a deal, and today they're second guessing things, or they're being more scrutinizing in how they approach things. They're trying to cover their collective risks. And they may turn down deals they would have done in prior years, or if they do a deal today, it has more stringent covenants, and it comes with costlier fees and other structures.
In some types of real estate lending, for example, we're seeing banks be very strict in the nature of their agreements and the structure of their agreements. We're seeing substantial recourse requirements. We're seeing drastically reduced loan-to-value ratios. In most cases, in order for a bank to even consider lending, we're finding that they are requiring the borrower to maintain substantial accounts, other accounts.
Correct.
With the bank so that they have collateral and a multifaceted relationship. Are you seeing that as well?
Yes. Additionally, where personal guarantees would not be the norm, when a company normally has enough cash flow or enough asset strength, today those personal guarantees, particularly in privately held companies, are being required by the credit folks at the banks.
It's amazing. Makes banking relationships and borrowing challenging, to say the least.
There's an old saw that banks lend money when you don't need it, and to a large degree that's true.
Yeah.
Of course you need it to grow, and of course you're trying to finance a number of things that you're doing. They increase your flexibility, but you have to be able to survive without the banking agreement before you can obtain financing today, unless you're going to the more asset-based approach or you're going into venture capital.
Let's shift gears a little bit. Let's talk about companies and customers. Today, given where we are, what steps are companies taking when working with their customers to make sure that their customers continue to buy, but at the same time making sure that they're paying their bills in a timely manner?
There's always a conflict between paying customers and slow-paying customers, but oftentimes slow payments are better than no payments. You have to find a way in economic times like this to make sure that you balance the needs of your customers with your own need to have a paying customer and a profitable customer. It's important to get into the understanding of what's going on when a customer starts to drag payment. Communicate with that customer. Try to understand if it's their financial strength or if this is short-term or long-term in nature. Is it something structural to the industry that you're serving? And make sure that you don't get trapped into that situation where customers bounce vendors off of vendors. For instance, if somebody owes you money for 90 to 120 days, they're not going to call you to replace that order as they normally would because they know you're going to want payment. Right. So they go to vendor B and vendor C and so on and so forth. And when it's your turn to receive an order, typically they're willing to replace that invoice and new order with a check for the old invoice. So by communicating with them, perhaps you could become part of their ongoing sales turnover, and by negotiating either a payment plan or an agreement about how to deal with the old issues at the same time nurturing a good customer, it can do two things. It creates some vendor-customer loyalty, and it also keeps you from failing and losing business.
So the name of the game is communication, customer service, and not just waiting for payment, but being actively involved.
And ask questions.
And ask a lot of questions.
Yeah.
That's, you know what, that makes a lot of sense.
Yes, it's like the man on Jeopardy. Ask questions.
Tim, what have you found more troublesome? Revenue weakness or expense management? And how are companies that you're familiar with dealing with both of those?
Interesting. In turnarounds, the holy grail in turning a company around always is, how do you grow the company? And also, when companies find themselves in a downturn, typically they try and buy their way out by increasing the top line, the sales line, but sometimes that comes at great cost. So although you have to go into an organization or into a situation with a turnaround, and if you do this as an internal team or as an external consultant coming in, you still have to go through the same process, address which customers do you make money from, how much, and which customers do you not. And oftentimes, the customers that you do not make money on, you're better off dropping now rather than trying to hold on and subsidize until a better day comes. At the same time, you have to focus on the bottom line. You should go after cost, use an 80-20 rule. Start at the top with the big items and end with the small ones at the end. But in so doing, rationalizing the entire process. Cash is king. You've got to identify it, hoard it, save it, and line up resources for further growth.
Tim, we're running out of time. I thought there were superb answers. We could spend an hour or two talking about more of this stuff, but I want to thank you for being here today on CFO Video Interview Series. This is Andrew Zezas with Real Estate Strategies Corporation as part of our CFO Video Interview Series, saying thank you very much for watching today, and we'll see you soon.
Thank you, Andy.